So thank you very much for joining us today for today's Newcastle Discover event, Pension Essentials. Hopefully the rest of the event will go slightly smoother than this start. But I'm Lucy Pritchard, I'm Alumni Relations Manager. And just to reiterate that this is an independent seminar and it's not linked in any way to the university's formal pensions communications and recent educational and update sessions that have been held for staff. So I know we do have some staff joining us today, and none of the things that will be discussed will be related to the university's pensions communications or schemes. I would also like to say, with this being an independent seminar, a big thank you to our alumna and our Alumni Achievement Award winner, Maria Nazarova-Doyle, who has helped us organise this event and has kindly offered her colleagues' services, Martyn from Scottish Widows. He has worked in the financial industries with Lloyds Banking Group for 12 years. And for the last 3 years, he has worked with Scottish Widows, presenting on the workplace pensions to help customers understand more about their future savings. Now, Martyn has a passion for presenting and ensuring that everyone can take charge of their finances. So Martyn, I know you're going to do a better job technically than I am right now. So thank you very much for your patience, and I will pass over to you.
Thank you very much, Lucy, and hopefully everyone can hear me so far. What I'll do, I'll just share my screen just while I'm doing that, just to introduce myself, as Lucy's very kindly done. So my name is Martyn Allan. As Lucy's mentioned, I'm part of Scottish Widows, working with Maria Nazarova-Doyle, who, of course, both working for Scottish Widows, and hopefully going to give you some good information today about your, well, I guess, answering questions about pensions, understanding a little bit more about what you can learn, how you can save, and just generally how pensions works, what we call our pension essentials. So probably for the next half an hour or so, I'm going to be talking through this presentation slide deck, after which I'll hopefully be able to answer all questions that come through on the Q&A facility as well. So without any further ado, hopefully you can see my screen here and hopefully you can hear me. We'll get started and we'll just talk about the agenda for today. So firstly, we're going to start off with just a very brief history about Scottish Widows, just to let you know why we're here, why we're in a good place to be talking about pensions. Afterwards, we'll move on to the basics about workplace pensions and pensions in general. We'll talk about investments, we'll talk about online pension services and pension transfers. And at the end, we'll just have a quick think, what could you do next? Now, there's absolutely no homework on the back of today's session. I'm not going to send you away to do anything in particular at all. A pension is up to you. It's your personal finances, it's your personal savings. So anything you do want to do, of course, it's completely up to you. Another thing just to mention before we get started, when it does come to answering questions, I'm not going to provide any financial advice today. Of course, I will be very generic in terms of course, I work for Scottish Widows, but you will have pension products elsewhere, etc. So I can't dive directly into different online services, for example, but hopefully I'll be able to answer your questions fully. So, Scottish Widows, well, our slogan, our thought process is always taking on your future together. Essentially, though, why are we in a good place to talk about pensions? Well, we've been around for just over 200 years, and we've always had the value of delivering the best possible customer outcomes. And currently, we're one of the largest pension providers in the UK. Well over 2 million employees save for their retirement with us here at Scottish Widows. Now, of course, you might not be a customer with Scottish Widows, but that's absolutely fine. Of course, it's all about understanding what a pension is, in particular workplace pensions, and really making the most of your savings. So, to get started, let's talk a little bit about the basics about pensions. So what we have here in front of us is an example of a workplace pension. Now, with a workplace pension, you'll be happy to know it's not just yourself that pays into the plan. What will happen is you'll have your pension pot, which hopefully you can see symbolised by a piggy bank in the middle of the screen here. And into your pension pot, into your piggy bank, there's different ways of growing that money. Firstly, any payments that you make into the pension plan, typically they'll be matched or a contribution will be made in return by your employer. So your employer is also going to help grow your workplace pension. When you do make contributions or payments into your plan, you're actually eligible to receive tax relief on all the money that you pay into your plan. And all the money is then invested with your provider's particular investment strategy. And of course, your money tries to grow even further through those investments. So a workplace pension in particular is a fantastic thing to be a part of. It means that although, yes, you are saving towards your pension, you're not alone. You're getting a lot of help from your employer, the government in terms of tax relief, and hopefully the market in terms of investments. Now, when it comes to a personal pension rather than a workplace pension, that is very much down to yourself. So that would just be based on the payments that you make into your plan, when you want to make them, and how much you want to pay in. Now, moving on from there, just to give you a bit of an example about how the contributions would work with a workplace pension, what we have here is a very standard example of somebody who earns £24,000 per year. That keeps the maths nice and simple for me. That's £2,000 per month. This person has decided to pay a contribution of 5% of their salary into their workplace pension. And in return, their employer has agreed to also pay an additional 5%. So in this example, 5% of £2,000 per month, the employer contribution is £100. Your contribution as an employee is slightly different. Although it's 5% and still £100 in total, you're actually only paying £80 of that contribution, because remember that tax relief is going to secure the rest of that contribution. So for the £80 in this example that would come from your paycheck, from your pocket, you're actually saving £200 every single month. And of course, that's massively helping to grow your workplace pension and of course your retirement savings for the future. Now, depending on where you work, depending on how much you contribute, etc., your salary, your example is going to be different to what you see on screen here. So it's always worth getting in touch with your employer if you don't know what your contributions look like, and really understanding what you're paying and what you're getting in return from your employer. Now, sometimes we can find that our pension is paid through something known as salary exchange. Now, not everyone will have salary exchange, but if you do, it's good to understand how this works. Now, salary exchange is also known as salary sacrifice. If you have heard of either, don't worry, they are the same thing. For some reason, they just have two names. But essentially, this is where your payment for your pension plan, your contribution, is paid before tax and any national insurance. So it's actually taken directly from your salary. Now, the exchanged amount therefore reduces your salary or your taxable pay. Because you've reduced your taxable pay, that's where your tax relief comes from. Essentially, when your contribution is taken off of your gross pay becomes lower, therefore your tax bill is lower, but actually you're going to make a bit of a change in terms of your national insurance payments as well. Because you're contributing to your pension before tax and national insurance, your national insurance payment will reduce as well, making your take-home pay slightly higher. Now, of course, if you're again paying by salary sacrifice, salary exchange, your employer should be able to make you aware of this. If, however, you're not, again, your employer will know and they may have a salary exchange scheme. Now, you can find out lots about salary exchange just simply by Googling that or by looking at things like PensionWise or the Money Advice Service, and I'll talk a little bit more about those very shortly. For now, though, just to give you an example of how salary exchange works, again, we'll use the very simple mathematical example, somebody earning £24,000 per year. Now, essentially, rather than going through this entire table with you, what we'll do is we'll just look at the headline figures. So we have three columns in this table, one to explain what everything's for. We have before exchange and after exchange. So before exchange, this person earns £24,000 per year. The tax that they would normally pay is £2,286, and they would pay £1,732 in national insurance. That would mean that their net earnings after tax and national insurance is just under £20,000. At that point, this person would then claim or make their contributions to their pension and claim back the tax relief. The take-home pay is £19,022. However, if we look at salary exchange being in place, Because we're taking the pension contributions off the top line, it means that our gross earnings have reduced. So £22,800 is our new taxable salary. Because of that, the tax we pay is less. The national insurance we pay is also lower. And that means that our net earnings are, as you can tell here, very slightly lower. However, because we've already paid our pension contribution by this point, we're actually in a place where we don't have to reduce any further. That means that our take-home pay in this very particular example is just over £140 per year more than what it would have been without using salary exchange. Now, that's not necessarily a good amount of money to write home about. However, I hope you'll agree it's much better in your pocket than in anyone else's. When your employer uses salary exchange, they'll also make benefits in terms of tax relief and national insurance, and in quite a few circumstances, they may share the benefits of their tax insurance savings back with you. Now, typically I'm asked when I'm talking about pensions, when I'm talking about contributions in particular, how much should I be paying? And really my answer to that is, well, as long as you're making a contribution of some sort, you're making a huge impact on what your retirement might look like in the future. But really, people want to know a specific figure. So Scottish Widows, we've done a lot of research, typically in the market, of how people want to live in retirement, how much money they feel they might need. We've done quite a few retirement reports over the last few years to help us understand a little bit more about spending habits and saving habits. And essentially what we can recommend is that between you, your workplace, and any tax relief that you receive, it's recommended that you try to save around about 12% into your pension plan. Now remember that 12%, it's not just what you pay. Your employer also makes their contribution, and any tax relief you receive can also be included in this 12%. That might mean that you pay 9% of your salary and your employer pays 3%. It might mean that you each pay 6%. Different employers have different contribution structures, depending on how they're set up. Hopefully you'll be able to reach your 12% target and hopefully save as much as you can for retirement. Remember, however, based on your affordability, based on what you want in retirement, it is different for everyone. And as long as you're making some sort of contribution, you are making a huge impact to your future. Now, when we pay into our pension plan, and when we come to take money from our plan, we are subject to certain allowances and rules. Speaking of allowances, the first one to talk about here is something known as the annual allowance. Now, the annual allowance refers to how much money we are allowed to pay into our pension plans each year without incurring any additional tax charges. So remember, we're going to get tax relief on pretty much everything that we pay into our pension plan. However, that's up to a limit of £40,000 per year. Now, that's for the tax year 2021 to 22. However, this, I think, has been frozen for the next few years, so it will look very similar for the next few years. Essentially, if you pay any more than £40,000 into your pension plan in any given year, you'll not receive tax relief on the amount that you pay in above £40,000. However, any unused tax allowance in any tax year can be carried forward 3 years. Therefore, if you didn't use your full £40,000 last year, but you did want to make the most of that this year, you could use the additional that you didn't use last year. Again, for more information on that, you should speak with your pension provider, or indeed look at PensionWise or the Money Advice Service, who can explain in even more detail what that means to you and what that looks like. Something else that we have to think about is something known as the lifetime allowance. Now, when it comes to actually taking money from your pension plan, it's also tax efficient. So you're allowed to take up to 25% of your entire pension tax-free. The rest would be subject to pay as you earn tax. There's different ways in which you can access your pension as well. However, when it comes to withdrawing money from your pension, you'll not receive any additional tax charges as long as you take less than the lifetime allowance. At the moment, the lifetime allowance is £1,073,100, which is very specific. This tends to grow alongside inflation, alongside cost of living. So we won't expect that to be just over £1 million for too much longer. Typically, however, The majority of people will not save up as much as the lifetime allowance, which means you'll not need to factor this in at all. However, if you're in the lucky position where you are nearing, or if you're getting close at any point to the lifetime allowance, you may consider speaking to a financial advisor. They can often help to understand where you can save your money in different places to help benefit from tax and profits from investments. However, if you continue to save over the lifetime allowance and end up withdrawing more than a lifetime allowance from your pension plan, you will receive a tax charge of 25% for any money that you take as an income or a pension, or a 55% tax charge for any money you take as a lump sum. So really, without wanting to pay any additional tax, it's often best to speak to a financial advisor. Of course, that typically does cost to gain financial advice, but it can save you a bit more in the future. Now, typically when we talk about the workplace, when we talk about having a career, most modern careers, or most modern people typically have around about 11 different jobs in their lifetime. Now, having 11 different jobs can be with one company, meaning that you'll always have the same pension provider or be part of the same pension scheme. However, in a lot of circumstances, moving job often means moving employer. So what happens with your pension, with your current workplace and your current pension provider, if you were to move to a new employer who has their own pension scheme? Well, typically you can leave your pension with your current provider, so whether that's Scottish Widows or any other provider in the market. They will continue to look after your pension. They'll continue to make investments. You'll still be able to access and find out more about your pension and make changes at any time. In most circumstances, you can also continue to pay in personal contributions. So anytime you have additional money or any money you'd like to put into your pension plan is, of course, up to you. In a lot of circumstances, people might find it a little bit easier to have all their pensions in one place. If that's the case, you're always allowed to move or transfer your pension to your new employer's provider, and that might make life easier in terms of managing your policies. Now, that brings us really to the end of the first section, minus probably something that's on people's minds, hopefully not something that we're thinking about or worrying about too often, but something that we should all be aware of, which is how to spot a pension scam. Now, it's unfortunate that we do need to talk about pension scams, but there's always going to be people who try to get access to other people's money for free. We, however, can be a bit more vigilant, and we can be prepared to deal with pension scams. Typically, there are some red flags. So if you're contacted about your pension out of the blue, typically that's not something that pension providers will do. We'll often write to you about any changes that are being made, or if you're approaching retirement, we will get in touch to discuss your options. However, out with that, we wouldn't normally phone you about your pension or email you or send a letter to ask you to do anything with your money. If you receive an offer that sounds too good to be true, often it is. Of course, pensions are regulated, so of course you're not going to get a particularly incredible offer that nobody else would provide. If you're offered access to your pension before early retirement age, again, pensions are regulated. We cannot offer anyone access to their pension before a particular age. If you're expected to invest in an unusual asset, again, you shouldn't be getting told where to invest your money. It is a choice that you can make. If you're asked to withdraw any money from your pension in order to get a deal, again, that's a big red flag. And finally, if you're told to act quickly, for example, within the next few weeks, you have to do this to get the best deal. Again, that's not how pension providers work. Now, for the latest guidance on your pension, you can visit moneyhelper.org.uk. They have lots of fantastic information about pension scams, how to be more vigilant, and of course, some more examples of red flags like I've talked about today. However, the main thing to think about, as we do in daily life with any communications that we get, whether it's a phone call, an email, a letter, a text message, if it's a contact that you don't feel comfortable with, that doesn't seem quite right, for example, if it's an email with lots of spelling mistakes or comes from an email address you don't recognize, then the best thing to do is to not respond, not reply to any contact at all. Get in touch with your pension provider on a number or an email address that you do recognise or that you've taken straight from their own website. And that way you can be sure that the contact was genuine or otherwise, without risking, of course, any of your own information or access to your pension. Again, it's a shame that we do have to talk about pension scams, but there will always be some people who try to access your money, of course, without your say-so. For now, though, we're going to move on and we're going to talk about pension investments. Now, I'm not going to spend too long talking about pension investments because, of course, every different provider will have a different investment strategy. But typically, when it comes to pensions, when you pay your contribution, your workplace might pay their contribution and any tax relief. Each time you pay into a pension, all that money is invested by your pension provider. The reason your money is invested is to try and grow the value of your pension pot as much as possible, whilst also helping out typically equity or stocks and shares markets throughout the UK and the rest of the world. So just to give you a bit more of an idea about how investments work, it's all about risk versus reward. Now, the word risk we don't like talking about either. Essentially, when it comes to having any investment at all, there is always a level of risk involved. The risk is that the value of your money, although we're trying to grow the value, there is always an opportunity or a chance for the value of your money to fluctuate both negatively and positively. Typically, if you look at an investment on a daily basis, you'll see the value of the investment going down and up all the time. Typically, over a longer term investment, such as a pension plan, you will see that growing over time. So although there will be months, days and weeks where the investment doesn't look great, over the longer term, typically it grows incredibly well. Now, we can't promise any investment return, no provider can, but what we can do is we can do our best to mix up the different levels of risk we take and try and get you that best possible reward for your investments. So what you'll typically see with investment strategies are some low risk investments, such as cash investments. They don't tend to make an awful lot of profit, but they're low risk. They don't tend to fluctuate negatively or positively by an awful lot. You might have medium risk investments such as bonds or property investments. Just to explain a little bit more, bonds or corporate bonds are where you invest money into companies or into the government for a fixed rate of interest each month. Again, there's always a risk that the value of your bond could drop, but typically you'll always get a certain level of reward or interest for the money that you've put into bonds. Property market, again, about investing into commercial or retail property in order to try and get an investment return. Where the majority of investment reward or profit comes from typically is stocks and shares, also known as equities. Now, your pension provider will probably be heavily invested into equities, meaning that they're trying to grow the value of your pension pot as much as possible. Now, this is where the higher level of risk is. However, because we're talking about pensions and long-term investments, it does mean that we don't have to worry too much about the level of risk we're taking at any given time. However, the level of risk that you want to take can be decided by you. Each pension provider will have different levels of risk that you can take, different investment strategies and products that you can be involved in. That way, if you wanted to take a lower level of risk because you're not too keen on taking a risk with your money and you're not too worried about the size of the reward at the end of the day, then you can do that. However, if you find yourself, for example, a little bit further away from retirement, you're happy to take a bit more of a risk, you could move into a higher risk investment strategy if you wanted and try and aim for the best possible returns. Now, at Scottish Widows, but with many companies in the UK market, we are trying to make a positive impact on the world with the investments that we make. And typically, what you'll find is each investment or pension provider will have a certain range of products which are known as ESG or environmental and socially governed products. It's all about reducing carbon footprints, making solid investments into our social and economical environments, and of course, being as environmentally friendly as possible. Most pension providers are very open with what they have available for you to invest into, And of course, most are making changes to their standard investments to make sure that they're reducing their carbon footprint. For example, Scottish widows have committed to reduce their carbon footprint to net zero by the year 2050. It seems like a long way away, but with these things, it can take quite a lot of time. A lot of other pension providers have done something similar. Now, when it comes to understanding your investments and the risks that are involved, what we have to look at is something called pound cost averaging. Now, I'll not go into too much detail, and I'll try and give you a very easy example that I can understand a bit better. But essentially, it's all about how does my money work for me and how can my money grow? So if we think about a regular workplace pension, so each month when you receive your paycheck, you'll be making a contribution to your workplace pension. That means that your contribution is going to be the same every month of that particular year until you get a bonus or a pay rise or whatever it might be that may affect how much you pay in. Because you're paying the same amount regularly, that's what helps us to understand pound cost averaging. So in this example, we're going to talk about 4 months. However, usually this is done over a 12, 18-month period. So it's a lot longer in real life, but this is to try and simplify things as much as possible. So in the first month, we invest £100 into our pension plan. That's our contribution. That's what we're paying in regularly. In the first month, each investment unit that we buy is worth £1. That means that we've bought 100 units and we have a fund value. If we were to sell all those units right now, we have a fund value of £100. So we've made no money, but we've lost no money. In month 2, we invest £100 again, because that's our regular contribution. However, the value of the units have gone down. So each unit is now only worth 80p. That means that we're buying more units for our £100. In this case, we're getting 125 units this month, meaning our total is 225. But because all of the units are now only worth 80p, it means our overall investment of £200, if we were to sell all of our investments, we would only get a return of £180. So actually, we've made a loss in that first month. In month 3, things get a little bit worse still. The market's in a bit of a decline. Share prices are going down. And of course, you'll see lots about that on the news. And for anyone who follows things like the FTSE 500, for example, you'll find out a lot about that as well. But again, we're investing £100. That's our regular normal contribution. The unit value is now only 50p. So actually, we're buying lots more units, in this case 200 additional units. But even the units that we bought for £1 or for 80p in the last 2 months, they're now only worth 50p each. So our overall value is now only £212.50, although we've invested £300. This is where typically you'll look at your pension, whether you're looking at your pension online or if you get a statement, and you'll start to think, is this the right thing for me to do? However, pensions are an incredibly long-term investment, as I've mentioned. And at some point, typically quite quickly after the market takes a downturn, the market tends to recover quickly. In month 4, we're investing £100 again. Each unit again has gone back to £1, which means we're only buying 100 units this month, so we're buying less units for the same amount of money. But overall, we've now got 525 units for the £400 that we've invested. The units that we've purchased previously, whether they were £1, 80p or 50p, are now all worth £1. That means that if we were to sell our £400 investment, we would get a return of £525. Now, as I've mentioned, this is a very short-term example of over 4 months. However, if we think back to the start of COVID-19, what you would have seen is we first initially went into almost a lockdown at the end of March. In April 2020, we've seen a dramatic reduction in the value of shares, stocks and shares in the UK market. However, even 1 month later, the economy started to recover again because people were able to work. We were going back to work. We were able to work from home depending on what job you did, etc. And the market was recovering. So even if there are downturns in the market, we've seen them before, for example, back in 2008, 2009 with the credit crisis. However, typically the markets bounce back. If we look back over a 30, 50 or even 100-year history, investment values have increased over the years when we think about investments as long term. So this is hopefully a nice, easy example to prove to you that paying regularly into a pension is very much worthwhile. And although your value will fluctuate all the time, when markets are good, your pension is worth a lot more than it would have been if everything had remained very, very good over those last 4 months. There's lots more information you can find out about that, again, using your own pension provider's website. If you are with Scottish Widows, of course, you can find out more information on our website, or again, by looking into things like the Money Advice Service or PensionWise. Now, we're going to move on from here and talk a little bit about how you can typically manage your pension online and where you can find out more about pension transfers. Now, each provider should have their own information website that you can access at any time. So typically it's just a case of Googling or searching online for the provider's name and going straight to their pension website. Now, on these pension websites, this is where you can find out a great deal of education and guidance about how your pension plan works, the ins and outs of the changes that you can make, things like changing or finding out more about investment strategies, and of course, things like COVID-19 updates. For example, you can see in the screenshot that I've used here, Scottish Widows have provided a COVID-19 update, where essentially we're there to kind of almost put your mind at rest about what's happening with investments and pensions in the background during this pandemic. So there's lots of great information and guidance you can find on your provider's website, and that'll help you to understand more about your plan. If you wanted to go a little bit further, most providers have an online ability where you can register to view your own policy using a secure online service. If your provider does have access to something similar like an app or just an online profile, then it's always best to register for this as soon as possible so you can manage and check your pension on the go or indeed at any time you wish to. If you do manage to register for an online service, typically it means that you can go ahead and make changes to your pension plan should you wish to. You can always check the value of your pension plan at any time. You can view statement history, so who's paying money into my pension plan, when are they paying and how much. You can typically change or find out more about investments. We can also talk about transferring previous pension pots and managing beneficiaries. Now I'm going to speak a little bit more about those two in a bit more detail. But most, if not all, UK pension providers will allow you to access your pension online. Again, whether that's through a mobile app, for example, that you can download computers, tablets, or phones, or if it's through a particular website. It's up to you if you want to register for the online service with your provider. Typically, it can be easier to manage your policy, but of course, it is personal choice. Now, I did mention we were going to talk a little bit more about those bottom 2 points, and one of the things is not something that I like to talk about at all. It's morbid, it's something that we need to mention when we talk about pensions, but it's not fun. It's all about what happens to your pension when you die. Now, with an employer, you might have certain policies or assurances in place for your health, but much like having your own individual life insurance, your pension policy comes along with what's known as a nomination of beneficiaries process. So whoever you hold your pension product with, it's always best to complete a nomination of beneficiaries form. Now, this is your way of telling your provider, should the worst happen to you, who's going to be in line to receive the money that you've saved up for this particular pension. Now, normally you can nominate absolutely anyone you like. They don't have to be immediate family. And you can also nominate multiple people, so you don't just have to pick one person to leave your money behind to. Now, normally you can also update your form at any time. So if your circumstances change, for example, if you have kids or grandkids, if you get married or get divorced, of course, or if you just decide you don't like somebody very much anymore, then that's completely up to yourself and you can change your form at any time. Again, typically these can be done online, or you can download a copy from your provider's website. Now, the reason that this is beneficial for yourself and your loved ones is because there's actually different rules associated with inheritance in this manner than there would be from normal inheritance, such as 40% inheritance tax. When it comes to tax, when you leave your money behind in this way, if you die over the age of 75, your loved ones will pay tax just at their normal rates. However, if you die under the age of 75, then whoever you leave the money behind to typically doesn't pay any tax at all. Your provider should pay the money out much quicker than a solicitor would as part of an estate. And again, normally there's no fees for that process at all. So it's cheaper, quicker, and more tax efficient for your loved ones. If you haven't already signed up to your online service with your provider and completed a nomination of beneficiaries form, it's certainly something to think about going forward. Another thing that I mentioned I would talk in a bit more detail about is pension transfers. Now, actually, when I do presentations, this is probably the number one question I get asked. Now, I did mention earlier that throughout a normal modern career, most people will have on average 11 different jobs. That means that there's a good chance that you might have more than one pension policy currently open. They might be with the same provider, they might be with different providers. You're actually allowed to have as many pension policies open as you would like. However, a lot of people ask me, can I combine my pensions together? And the answer in most circumstances is yes, you absolutely can. With normal personal or workplace pensions, you can typically transfer your pension using an online service or by getting in touch with your current provider. They'll get in touch with your previous provider and make a transfer happen as appropriately. If you do happen to have a final salary or what's known as a defined benefit pension, then the transfer process is slightly different and you would normally need to speak to a financial advisor. However, as I say, with normal workplace or personal pensions, it's very, very simple. There are, of course, a few things to consider. Firstly, do you want all your money in one place? Now, most pension providers, depending on the kind of product that you have, are registered and essentially part of the Financial Conduct Authority, regulated as well and under the FSCS conduct rules, which essentially means your money is entirely protected should the company that you are with disappears. Now, typically with different pension products, there's different rules in place, but you're welcome to have all your money in one place. It might make things easier for you to manage. If you prefer to keep your money separately, again, that's completely personal choice. Another thing to consider is what's the difference in charges. So every single pension that you have will have something known as an annual management charge. Now, generally speaking, that's the only thing you should be paying to a provider. And for standard pensions, these are capped at 0.75%. However, depending on your employer, depending on your provider, your annual management charge will vary. Whichever policy you currently have running right now should hopefully be the cheapest annual management charge. And if your other policies have higher annual management charges, it may be financially beneficial to combine those together to make the most of that lower charge. In terms of investment choice, which provider offers you a choice that suits you best? And finally, will I lose out on any special features or guarantees that my current provider has in place if I were to move? Now, each provider will have their own guidance and own process for transferring pensions, but typically you can find out as much information as you need to using your own information from your different pensions and from your current provider's website. Now, a few final thoughts to finish up before we go ahead and start answering questions. A bit of a summary of what we've talked about today, but first and foremost, review pension plans. What pensions do you currently have open? Are you currently saving for a pension? It's best to keep track of absolutely everything you have, because essentially when we're thinking about pensions and our future income, we don't want to lose track of anything and end up missing out on money that we've saved. You should consider if the investment strategy you're currently involved in is right for you. Do you want to take more risk? Do you want to take less risk? Are you happy somewhere in the middle? Are you happy with the performance you're currently getting from your investments? Consider if you're paying enough into your plan. Can you afford to pay a little bit more into your pension? Are you making the most of your workplace contributions? Think about your retirement income options. How can you access your money? If you are pushing on towards retirement, then what's the best way for you to manage and access your money a little later down the line? And finally, consider combining any pension pots together with your existing pension plan. It might make life easier for you, but remember, there's lots of guidance to be found online. Now, before we finish up, I thought it'd be useful to just provide a couple of good links for you to find out more information about pensions in general. Firstly, we have information on the government's state pension. You can find that at gov.uk/check state pension. They're really good at naming their websites at the government there. The next one you can tell is gov.uk/find lost pension. Hopefully you can tell they're there to help you track down and trace any pensions that you may have lost over the years. Next up, if at any point you wish to speak to an independent financial advisor, it can often be beneficial, but remember there's always a cost associated with that. You can visit unbiased.co.uk or vouchedfor.co.uk, and they can help to find an independent qualified financial advisor in your local area. The last two websites we've mentioned here, I've mentioned a couple of times as we've gone throughout the presentation today. So Money Helper and PensionWise, again, government-run services, but fantastic source of information to find out more about pensions and hopefully to help answer any questions that you do have. For now, though, I would just like to say thank you very much to everyone who's joined us today and for anyone who's listening in the future to this recording. Hopefully that's been a good use of your time and provided a good bit of information about pensions. I'm now happy to go ahead and answer as many questions as I can today. But again, thank you very much for having me, and hopefully I can answer any questions that you've had. So let me just open up the chat facility or the Q&A facility if we do have that here. Excellent. So the first question I've got here, what's a reasonable monthly pension contribution? And should I have a separate savings account, for example, a lifetime ISA, as well as my work pension? Apologies while I go on mute to have a little cough there. Fantastic question, really great question. And hopefully I managed to answer that a little bit earlier on when I was talking about a recommended pension contribution. Now you've asked what's a reasonable monthly pension contribution? Now, workplace pensions are actually, they have a certain limit that you need to pay in. And at the moment, that's 8%. That 8% is a combination of what you pay and your workplace. So typically you'll see you might pay 5% and your workplace might pay 3%. You might have a different contribution structure that pays more than 8 as standard. So 8 is very reasonable, again, inclusive of you and your employer. But as well as that, you may wish to consider the recommended, which is 12. You've asked as well, should I have a separate savings account, such as a lifetime ISA? Fantastic question, and it's a personal choice again. If you feel like you have the ability to have additional savings where you might want to access these savings in a different manner or a little bit quicker, then absolutely it's great to have multiple products where you can maybe have different levels of access, can maybe dig into these accounts at different times, and you might benefit from different allowances such as your ISA allowance and of course your tax relief with your pension plan. Great question, though, and thank you very much for that. The next question I have here is, how do pensions work if you're currently employed in the UK? Oh, that's just disappeared. Sorry, if you're currently employed in the UK, but then you move to work in the EU or you become self-employed either in the UK or EU, would you still be able to claim back your pension even if you've only made very few contributions? Fantastic question. Yes is really the very vague answer, but just to explain in a little bit more detail. If you do move overseas, whether that's within the EU or to a country out with the EU, you can still keep your pension in the UK. For example, if you leave your pension with your provider in the UK, it may not grow any further from future contributions that you make because you may be working and saving a pension in a different country. However, you'll still be able to access and then claim that money back when it comes to the right time. Now, the only thing you would need to consider, of course, are the tax rules in the UK for accessing your pension and any exchange rates when you do move that money overseas. In terms of becoming self-employed, again, very, very similar. If you're self-employed in the UK, again, you can keep your pension where it is or transfer that to a new provider. But when it comes to having a self-employed pension, it's more like a personal pension where really you're paying in. And because you're your own workplace, typically you don't get a workplace contribution. But the tax relief is still very much in place when it comes to self-employed pensions. The other thing to think about when it does come to moving money overseas or moving yourself overseas is the ability to transfer a pension from the UK to an overseas company. Now, there is something called QROPS, which is the Qualified Recognised Overseas Pension Scheme, if I remember correctly, which essentially means if the country you move to is part of this QROPS list, then typically you can transfer pensions from the UK to this country without any bother. These are all looked at on an individual basis, and some charges may apply depending on who your new provider is. You'll also be subject to the pension and tax rules in your new country of residence. In some circumstances, pensions cannot be transferred overseas, so you might be best to keep them in the UK. But it's completely up to you, but there are options for you, and it's always best to speak to your provider on an individual basis if you do have that issue. Excellent. Next up, I would like to hear about how to consolidate different workplace pensions from different providers. Hopefully I've given you a bit of information on that question, but just to dive in a little bit deeper, workplace and personal pensions are incredibly easy to transfer. Normally, it's an application form done online, which takes around about 5 minutes. You'll need a bit of information about your different policies. So, for example, if you had a current pension with Scottish Widows and another pension with somebody, for example, Aviva, then you could take your information from your Aviva policy. You could fill that in as part of the application form with Scottish Widows. Us here at Scottish Widows, we'd then get in touch with your provider at Aviva. We'd talk about the pension transfer, make sure we've got the right account, the right amount of money, and get that transfer done as soon as possible. Now, if you have 2 pensions or if you have 22 pensions, it doesn't matter. We can look to transfer any amount of pensions that you like. Remember, as I mentioned, however, earlier on, if you do have a final salary or a defined benefits pension, as it's technically known as, these are transferred in a very different way, and you would need to seek financial advice if that pension is worth any more than £30,000. So a bit more detail than I've added in the presentation, but hopefully that's answered your question. Excellent. The next question I have here is, I am self-employed. What type of pension would you advise and what level of contribution would you recommend? So with a self-employed pension, as mentioned, these are very much like personal pensions. Although you can, as part of your own self-employed workplace, you can use contributions from the business's profits to pay into your pension. But typically these are seen as personal or self-employed pensions, which work in a very similar way. So you'd still have the same expectations of your pension being invested. You'd still be able to access and manage your pension in exactly the same way. And depending on your provider, they may have a very specific product for a self-employed person. So when it comes to what type of pension would you advise, again, without giving any financial advice, typically a personal or a self-employed workplace pension is very easy to come by, and any provider would give you more information about how you can access and how you can manage these policies. Now, there are different kinds of pension products. For example, you've got a stakeholder pension, you've got a group personal pension, just to name 2. There are many more than that. You've got master trust pension, for example, as well. These all work in very, very similar ways. It's the way that the pensions that are governed that changes. So actually, when it comes to results, performance, and how you can access your pension, they are all very, very similar. But another great question, and clearly some self-employed alumni of Newcastle University. Next question we have here is, how much of a risk are personal pensions, particularly within the current economic climate? Are there any alternative saving plans that rival pensions with regards to long-term investment? A fantastic question. And again, without treading on the toes of any financial advice, there are lots of different national savings and insurance products, investment strategies, bond investments that you can do on a personal basis, as in a personal savings or an alternative savings plan that you can use to run alongside your personal pension. However, when it comes to the risk of a personal pension, Scottish Widows, any other provider in the UK, the reason that these companies are regulated, they're able to make these investments on your behalf and manage these investments for you, should you wish them to, is because they've been doing this for a number of years, and they're regulated to invest only into particular streams, particular markets, and of course, they're responsible for making as much positive change as they can. So although you are taking a level of risk each time you make an investment, particularly with a pension, it's a long-term risk, and actually it's easier to invest over the long term than it is to invest over the short term. So although there is a risk there, typically you'll find, again, using your provider's information site, for example, or by getting in touch with them, they can talk to you about previous performance of investments, previous risk anomalies, things that have happened, for example, during the COVID economic climate. There are plenty of alternative savings plans. When it comes to alternative savings plans, however, you may not benefit from tax relief. You may find other allowances such as your ISA allowances and other investment allowances, but it's always best to look into the amount of money that you're going to be able to save whilst being tax efficient. Again, a qualified independent financial advisor is usually the best place to go. I've mentioned that a few times, and yes, it does cost money. If you go to Money Helper or Pension Wise, they can give you some fantastic guidance, but they can't step into financial advice. A really, really great question, though, again, and hopefully that helps. Excellent. Last couple I've got here just now. First one is, are there any costs associated with transferring over a pension, and any advantages of having several pension plans rather than combining? Great question. So typically, when it comes to transferring a pension, most providers now do not have any charges for pension transfers. Most providers have followed suit, and I'm happy to say they're all changing, so it's a little bit easier. However, some companies, some providers do still carry a small percentage or one-off fee. If that's the case, it will be obvious because you'll get a pension value and a transfer value, and the difference in those values would be the charge. Now, it is annoying when companies charge to do that because typically it should be free to do, but it's worth looking into, particularly if you're going to be saving a lot of money by transferring or combining your plans together. Second part of your question asks about any advantages of having several pension plans. It's a complete personal choice. And again, I don't want to be vague with the answer there, but it is a personal choice. If you'd prefer to have your money in different places, perhaps using different investment strategies, access your money at different times, use those for different income reasons, then you might find your own advantages with having several pension plans. However, if you're just there to save the money, if you're just there to make it as cheap as possible, of course, and as easy as possible, typically combining your pensions might be the answer. But actually, it's open choice. If you're happy to have several pensions, you absolutely do not need to transfer at any time. The one thing I will always come back to is make sure you're always looking after that your overall pensions and not just the one that's active right now. I think that takes us to the end of the questions.
Thank you very much, Martyn. It's been absolutely fascinating and I've personally found it very interesting and very helpful for getting an understanding of pensions, a subject which I've always struggled with. So hopefully we've had a lot of feedback as well already from people who've joined us to say similar things. So thank you very much. Now, thank you very much to you for joining us today for this Discover event. And we have some more Discover events already in the pipeline. So tomorrow, in fact, we have one, should you be approaching retirement? Unfortunately, I'm not quite there yet, but Martyn is doing another talk for us about specifically planning your retirement. So if you're not near that stage yet in life, then don't join us, but do join us in March, we have From Bench to Bedside, the journey for cancer treatment, which will be fascinating to hear. Do just use the QR code or check out that link for all of the events that we have coming up across all of our series. And do keep in touch with us. So do join our alumni community LinkedIn group as well to continue the conversation. And I would just like once again to say a huge thank you to you, Martyn. It has been really interesting and been discussed in a really accessible way that even people like me can understand. So thank you very much for that. And thank you very much for joining us on your lunchtime. And we hope to see you again at another Discover event soon.